The conduct of an external audit is governed by fundamental objectives and principles that ensure the reliability, consistency, and credibility of the auditor's opinion. ISA 200 Overall Objectives of the Independent Auditor and the Conduct of an Audit in accordance with international standards on auditing establishes the conceptual foundation of every audit engagement by defining the auditor's responsibilities, professional obligations, and the framework within which audit procedures should be performed. The overall objective of the auditor is to obtain reasonable assurance that the financial statements as a whole are free from material misstatement, whether arising from fraud or error, thereby enabling the auditor to express an independent opinion on whether the financial statements are prepared, in all material respects, in accordance with the applicable financial reporting framework. This objective enhances stakeholder confidence in financial reporting while supporting effective corporate governance and efficient capital markets. Reasonable assurance does not represent absolute certainty because inherent limitations exist in both financial reporting and the audit process itself. Financial statements contain accounting estimates, management judgments, and assumptions that cannot be verified with complete precision, while auditors rely upon sampling techniques, analytical procedures, and persuasive rather than conclusive evidence. Furthermore, sophisticated fraud involving collusion, management override of controls, or deliberate concealment may remain undetected despite properly conducted audit procedures. Consequently, the auditor seeks to reduce audit risk to an acceptably low level through systematic planning, risk assessment, evidence gathering, and evaluation procedures before expressing an independent opinion. Understanding these inherent limitations is fundamental to appreciating the scope and purpose of external auditing. The International Standards on Auditing (ISAs) provide a globally recognized framework governing the conduct of audit engagements and promote consistency, comparability, and audit quality across jurisdictions. ISAs establish principles relating to audit planning, risk assessment, internal controls, audit evidence, documentation, materiality, fraud considerations, going concern, audit reporting, and quality management. Compliance with ISAs ensures that audits are conducted using systematic and internationally accepted methodologies while supporting professional judgment and consistency in audit practice. The standards also reinforce public confidence by providing assurance that auditors apply rigorous procedures when evaluating financial statements and communicating audit conclusions. Consequently, auditors are required to comply with all relevant ISAs unless exceptional circumstances justify departure from a specific requirement, with such departures requiring appropriate documentation and justification. Planning represents an essential principle underlying every effective audit engagement because it enables auditors to allocate resources efficiently, identify significant risks, establish appropriate audit strategies, and perform procedures responsive to assessed risks of material misstatement. Effective planning begins with obtaining an understanding of the entity, its industry, internal control environment, regulatory framework, business risks, and financial reporting processes. This understanding enables auditors to identify significant risk areas requiring particular attention and determine the nature, timing, and extent of audit procedures necessary to obtain sufficient appropriate audit evidence. Thorough planning improves audit efficiency, facilitates effective supervision of engagement teams, enhances coordination among specialists, and reduces the likelihood that material misstatements will remain undetected. It also supports compliance with international standards on auditing by ensuring that audit work is appropriately directed toward areas of greatest audit risk. A fundamental principle governing audit performance is the exercise of professional skepticism, which requires auditors to maintain a questioning mind and critically assess audit evidence throughout the engagement. Professional skepticism involves remaining alert to conditions that may indicate possible fraud, error, management bias, inconsistencies in evidence, or unusual transactions that warrant further investigation. Auditors should neither assume that management is dishonest nor unquestioningly accept management representations without corroborative evidence. Instead, they should evaluate evidence objectively, challenge assumptions where appropriate, and seek additional evidence whenever contradictions or uncertainties arise. The exercise of professional skepticism is particularly important when auditing complex estimates, related party transactions, revenue recognition, going concern assessments, and areas involving significant management judgment. It represents one of the most important safeguards against audit failure and enhances the reliability of audit conclusions. Closely related to professional skepticism is the requirement for auditors to exercise professional judgment throughout the audit process. Professional judgment refers to the application of relevant training, knowledge, experience, and ethical principles in making informed decisions regarding audit planning, risk assessment, materiality, sampling, evidence evaluation, and reporting conclusions. Auditors regularly apply professional judgment when determining acceptable audit risk, selecting audit procedures, evaluating accounting estimates, assessing the sufficiency and appropriateness of audit evidence, and deciding whether identified misstatements are material individually or collectively. Because auditing involves numerous areas where no single correct answer exists, sound professional judgment is essential to achieving high-quality audit outcomes while ensuring compliance with auditing standards and ethical requirements. Professional skepticism and professional judgment operate together throughout the audit engagement to support objective decision-making and improve audit quality. While professional judgment enables auditors to select appropriate procedures and interpret evidence, professional skepticism ensures that evidence is evaluated critically rather than accepted at face value. Together, these principles help auditors respond appropriately to uncertainty, detect material misstatements, challenge management bias, and maintain independence throughout the engagement. They are particularly significant in high-risk audit areas involving complex transactions, estimates, and potential fraud risks where management incentives may influence financial reporting outcomes. For students and audit professionals, understanding the overall objectives and general principles of auditing provides the conceptual foundation for every stage of the audit process. Compliance with international standards on auditing, combined with effective planning, professional skepticism, and sound professional judgment, enables auditors to obtain sufficient appropriate evidence and express reliable audit opinions that enhance transparency, accountability, and stakeholder confidence in financial reporting. These principles underpin modern audit practice and remain central to maintaining the credibility and public value of the auditing profession.